Signal South.
Welcome to Signal South. I'm Lisa Calhoun, your host and founder and managing partner at Valor Ventures. Super excited about today's edition of the podcast because I get to interview one of my dear friends, one of my favorite VCs ever, my partner and general partner at Valor, Gary Peat. Gary, welcome to Signal South.
Thanks. Great to be here.
It is great to have you here. I can't wait to jump into this conversation. We know each other so well. I feel like it's important to cover the bases for our listeners. So let's start with you. Why do you love investing? How did you get started in venture? Because it was long before Valor.
Well, I had this wrong way mistake twice in my career. I went to work for an investment bank on Wall Street that was very combative, long labor hours, and not good humanity treatment. Then I went to work in private equity in the Midwest, and we're buying basic companies. But in '98, we raised a growth fund, and they let me do a .com, as we called them in early '99, called SecureTax. It happened to be, here in Atlanta, and less than 15 months later, we exited for all cash 20 times our money.
20
It's my
times.
first deal as a partner of any fund
Wow.
anywhere. And
Gary, you have talent. Did someone tell you that at the time?
getting your first deal that good, there's this other thing called luck that might have played a part too. But nonetheless, it went fantastic. And the partners were like, wow, we want to do this some more. And I said, well, I don't want to do it a bit more. It's the only thing I ever want to do. And lucky for me, I got recruited to become the third partner at the founding of a venture capital firm in 2000. And from then on, I was doing seed stage investing in B2B SaaS in the South. And
Amazing.
that was, luck played a part, I think, in taking that deal and it happening so fast. But the internet was new. It's like when AI is new now, things get valuable fast. And I just fell in love with something other than just the money I made. I was really intrigued by the people that were doing so. They're some of the most interesting people I think that there are in the world. And, I won't digress on the fact that we now have the most successful entrepreneur in all of history as of today.
Really, really excited to talk about Valor investing too. But I want to give people a sense of your leadership in VC that includes Valor, thank goodness. I mean, I'm so grateful that we came across each other. One of Valor's LPs at the time in our first institutional fund, which had just gotten started, was like, hey, you need to talk to this guy, Gary, a friend of mine. And that was a huge stroke of luck, I think, for myself personally and also for Valor. But before that, you had already, for your own purposes, really focused on investing in the South. It's one of the things we had in common right in our first conversations. I would love for you to share a little bit more about some of that experience investing in the South more broadly. And I know how passionate you are about it, but you could have picked up and gone to New York or the West Coast at any time. What kept you investing in Southern Found?
Well, the first time I was a founding general partner with three of us as equal partners happened to be in the South. I was in the Midwest. I was in New York before that. So it's logical that I could have ended up out on the West Coast. They live a better lifestyle than Wall Street investment bankers. And I was successful in that first fund. We had 3 deals that returned on average 1 times the fund each. And that was an improbable thing. And it was really launched the firm and gave me a whole nother set of some of my best friends in life that were extraordinary entrepreneurs that, the goal is to find the entrepreneur in the South that can build. And I go back far enough where it was pretty hard. You had to recruit people into the region. And sometimes you needed talent from the West Coast and you just couldn't make that happen. So it has evolved. It worked for me then, and it has evolved to be workable in a way that's now competitive ecosystem building to the East Coast and the West Coast, except for very, 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 very bleeding edge. But that's
You
not really
mentioned
the business of, we're launching great companies. We don't always have to launch the next Anthropic.
I'm curious, are there other breakout deals for you personally that have helped you shape your lens as an investor?
One is the most patient I've ever had to be on a deal. I did a spin out of Georgia Tech, a professor named John Copeland. He's still there. Hi, John. He used a play on his name. The company was called Landcope IT Security. took 13.5 years for our fund to monetize, but it was 1.1 times the fund when it did. And it was bought by Cisco, just the sort of ideal strategic buyer who paid the ideal strategic price. So I, learned to spot deals that'll go faster than that is one of the
Yeah.
lessons.
When it comes to what it takes to back a breakout founder, though, what are some of the things that you've really learned to tune in? For example, how do you notice a founder that's going to go faster? Is that a learned behavior in recognizing them, or is that a learned behavior in coaching and nurturing them?
I would say the most successful I've had, what you've seen the numbers, soon is going to be a lot more because Valor is doing really well. But I have 18 companies that made it from post money somewhere around 10 million or less to either one between 100 million and 2.1 billion. And one third of those companies did not have the co-founder that was the CEO at time of investment, the person that's actually really bad. And it took a while for me to learn that some of your most successful investments will have to transition the founding CEO because not everybody is designed to be a CEO. So then you say, wow, that's really painful. What you really want is get good at picking someone who is that CEO that's going to take you all the way. And all you are is a supporter, a champion, a provider, resources, connections, capital. And they just blaze a trail like no others. What is the person that does that? I worked a long time and a lot of hours on how to evaluate that. Because when you have that, it just is extraordinarily different than if you don't.
George Aziz by name. He is the founder of FinQuery, which Valor had the great good fortune of backing at his first round and also had a lovely exit last year in Atlanta. That's a fantastic company. But to get back to what you've learned, I mean, Gary, I think you're very, very humble. And what I'm hearing is that two-thirds of your exits had the original founder at the helm, which is, of course, quite a bit and a
Yeah,
significant
two-thirds of
majority.
what I call the successful ones, the ones that
Yeah.
jumped into the 100 million and up club at exit.
And then sometimes you've had to find the right leader to take it at a scale growth, define the most successful founders in the South today at seed, things that you can observe at seed. What comes to mind for you?
Well, there's a bunch of instances in our life that we have deals we've done together. We're going on whatever deal number 30 together, I think, where we meet a team that has a bunch of shared characteristics amongst the founders, but one of them, of course, is the founder that's wearing the CEO title. What you find is you dig into their background and you ask yourself, well, how do we know they have the resiliency, the drive? Well, you sort of look under the covers and say, well, look at this. They have very good IQ, but look at the EQ of this person, especially the one
Yeah.
who's CEO. And, do they have drive and resilience and just, are they going to, well, look at that. These two were D1 athletes together at a school. They got engineering degrees while playing basketball at D1 level. And they're, as tight as bugs in a rug. And so they're going to be able to get through a lot together. And it pattern over and over and over the tight bond of friendship. Somebody is the leader and they look like they've got the characteristics to both be smart enough and, they're honestly, their EQ can be higher than their IQ because you can hire EQ, you can't make up. I mean, you can hire IQ, you can't make up EQ, right?
I was going to say also in these days, intelligence to some extent can be artificially loaded,
Wow.
but you know,
Mhm.
the
But true.
the emotional human intelligence to navigate a team, lead a team, grow a team, AIs are not leading us around on that level. In our conversations, and it's been so fun over the years. I mean, since you joined, to have those investment committee conversations about what's going on with the founders and what do we believe will be true. And there's so many unknowns and there's so many risks when you lead the first round as we do. But I love that coachability test. In other words, when they are bright, tight, great vision, but then you give them meaningful feedback. And I've seen this happen so many times. You'll land some wisdom from the last, say, 10 years of investing success. And the smart founders pick up on that, make it their own, embroider it, and they've got it back in the water in like 5 minutes flat. Now they have new insights. And I find that to be incredible. That lack of defensiveness and sort of no ego, just about success. It works or it doesn't work. I'm open to all input. I'm going to try it out. I'm going to make my own decisions. And that fail faster mentality, I think, is one of the things we've really learned to look at together. I mean, does that Is that how you would put it, or is there something else there we should
Well, fail
unpack?
fast, yes, but what is also a pattern that I've seen, the origin story, the logic and emotional sensibility of the founding team that we're backing, that all works, but not everybody is suited to be a CEO. So somewhere between, in my experience, between 1 and 2 or 3 million in ARR, suddenly needs to be high quality functional leadership reporting to the CEO, and thus the company can continue to scale. Otherwise, you're stuck. And many times that's where it falters when someone suddenly has to go. We have this joint philosophy, Lisa, on once the founding team is in their job and backed with capital, there's no reason for them to hire people that are a risk. You go, been there, done that talent, and we are really good at helping you get the right pieces of
It's
that.
really important. You know,
And
the tight friends perhaps in the co-founding first 1, 2, or 3, but after that, hire expertise. And if they don't perform to expectations in their resume, time to go. Because after that first core visionary team, it really is all about creating that momentum, not about learning on the job necessarily.
But we have in our partnership together, I would put you at least at expert level on the sales and marketing motion for B2B SaaS, including in the AI enabled era. And that's all I've ever invested in. And so we finish each other's sentences about this stuff. But when a founding team doesn't include somebody who scaled a company as a sales leader from 2 to 20,
Yeah.
from 3 people in the sales organization to 30, and still was kicking butt and taking names when the company exited and they went on to the next thing. If you don't have that person, then you don't have somebody who knows how to do that. And why would you hire somebody who doesn't know how to do what you, if you're so privileged that your company can scale, you have the privilege of probably lining up 3 people that are capable of it, and you pick the one that's your cultural fit, and then you'll look like the best CEO. You have the easiest job. You put the direct reports together correct, and you can scale a company to, extraordinary value in a short period of time. And if you blow that, it's really hard to do much of anything.
So, what have you learned about helping a founder be mentored through that process? Because one of the things that I think is so endlessly fascinating and that I've truly fallen in love with about the role of VC is coaching the best talent in their space. So the founders that we back and the founders that I personally have the privilege of being on their boards, they are 10 times better than me at what they do. That's why we backed them. But I find those opportunities, and it's partly why I personally am able to win the deals that I do win, to mentor them in key areas. And a lot of times, Gary, to your point, it is go to market, sales and marketing, things that I have almost 30 years of reps in. But how are you looking at your own mentorship? What have you learned? What would you say today, looking back, are your key mentor strengths so that founders who are listening to you today are like, whoa, we need that guy. He's the one for my friend David, Chris, or Christina.
The stage at which we invest, when you take all of our criteria and boil it down, we can turn it into 3 words: ready to grow. And that means the founders can get leverage from putting in place professional sales and marketing motion with someone who's been at scale in B2B SaaS market, leadership of a sales team of the size or bigger than are going to have for the next couple of years. And oh, by the way, they came from a market that they were selling to the same buyers. It's just a different value prop that you're bringing to your company. And that's regional sales managers at scaled up companies. Well, we've got a formula. We've got a recruiter. We're doing it over and over again. And our hit and miss rate on a sales leader is great. The other thing I tell the entrepreneur is, if I never get to influence you on how to hire, this first play out of the playbook, the sales and marketing leader, just ask for 4 data points. When you first became a sales leader, how many salespeople did you have? What was your annual contract value that first year, the TCV you booked? And then the last year you were in that sales role, how many salespeople did you have and how much TCV did you book? And if it doesn't go like this, they're not a candidate. If it's not straight up, because you can go find the people that have straight up and to the right. And those 4 data points, when you ask somebody how to hire a sales leader, I don't know anybody who says, oh, here's the 4 data points that quantitatively makes you a qualified candidate or an unqualified candidate. And it has worked time and time again for us together. And that is one of like 30 plays that we run together, which we
So what
can't.
I'm hearing you say is that founders can rely on you for operational expertise in what's next for the company, and that you've got playbooks informed by current reality that can be really, really helpful so they don't have to invent the wheel. Is that fair?
It's fair, but the first playbooks we run are learning how to hire the best, been there, done that talent and integrate it and manage it well and let it run. And that is really helping the founders add professional, been there, done that talent to their team. That's probably the most important thing they can do. We don't have to add them all at once, right? With the stage that we invest, but that sales leader playbook, we're really good at that. There's 23 other plays, right, that we run. And
Oh,
I'll just
absolutely.
give
Like how
you
to raise a great next round and but we
yeah,
can
well,
kind of
we are always about companies that show really strong evidence that their annual contract value or their per seat value is going to grow dramatically. We've had in one that we've been in not even a year, ESA law, the annual seat value has grown 74% in just 12 months and it's not done. And so you get when does an entrepreneur know that they have pricing power? Well, that takes a lot of measurement of what's going on in your customer base and then a lot of judgment. But
yeah.
when it's there, it's one of the most valuable things you can do. You're going to get more out of every time you have a customer. So we look for the things that our playbook can help.
Your passion for the details of what really creates success is one of the things I absolutely love about you. I also want to use this opportunity for people to just learn a little bit more about the man behind the experience. And so, if you don't mind, I'd really like to go into something a little bit more personal and ask you, it's very qualitative. Your toughest deal and what you learned from that because VCs are always talking about fail faster and learn and grow, and of course that's not just for founders, that's also for us as investors. What have you learned from one or two of your toughest ever deals?
Toughest deals tend to not be great on the return side. So I won't name.
Inherently, yeah, exactly.
But I think one of the toughest deals that happened, I learned a venture capital maxim by being on the wrong side of it. And that venture capital maxim is, would you rather have A management in a B market or B management in an A market? And some people will say, well, B management, but A market is better than being in a B market. Well, A management will take you to an A market. And if you're in an A market, you've got A management you're going to compete with. And if you're the one who selected the B management in the A market, you lose.
Yeah.
That was that. And I've done it twice in my career. I mean, we're not talking lose a little. I'm talking barely made it, to something that could be bought by somebody. And somebody ran the field just
Mm.
unbelievable well. Anyway, thus my quest for the right CEO that we can just hitch our wagon to the Mark Zuckerberg that we need and go.
So, what are some of the ways that you might have talent that's not a talent? Because, as you said, you really you've become a talent first investor. How do you get a sense that you might be working with, in your words, be talent? How do you learn to look to the next deal until you find the quality you're searching for?
I think the part that can't be measured at the stage we invest, right? When we lean away from seed, it's not toward series A, it's toward pre-seed. So we're core seed thesis. You're not tested on your capacity to manage great talent that's been there and done that. And at somewhere between 1 and 3 million in revenue run rate, if you can't do that, you falter in your growth.
I think one of the things that we really focus on to some extent is, of course, volume of deal flow. I mean, looking at almost 2,000 deals last year, if we have any doubts, and we often do, of course, we look at the next deal until we can create that high conviction. And I'm sure we are and have missed a talent in A markets. But if we weren't able to recognize it in that moment, that's on us. Thank goodness, with enough volume of deals across the South, we are able to find conviction in founders we're able to due diligence on at that first round.
One of the reasons why it's been such a core strategic objective of this firm, not made up by me, but also, shared by you before I even showed up at the party. Those things that go from nothing to worth a fortune in a short period of time are startlingly rare. If you're
They
not
are.
seeing an extraordinary volume of deal flow, you're kidding yourself. You're not seeing things that can go fast and be worth a fortune. And, that juggernaut of deal flow that we have, that's, a critical part of the reason it was an easy decision to join. We had a chance to find the gems. We had enough volume.
Absolutely. It's something we pay a lot of attention to. I know you and I were just reviewing our new sourcing dashboard framework, and sourcing's always been a big part of the firm's culture, but with the additional layers of AI and some of our AI infrastructure, including Vic, we're just able to continue to refine and enhance, now 10 years in, what sourcing feels like, looks like. Do we see the best? How fast are we able to respond? I'm super proud that we can respond to any founder that drops a deck on our deck check in 5 to 15 minutes, like, and details, right? And so that's sourcing solves a lot of issues for VCs, no doubt. But again, I'm going to tell myself, let's focus on Gary a little bit here
Well,
because
I love the changes we've made in sourcing because if you look at it now, there's really a lot more disclosure, right? So we use API access to PitchBook. We integrate that into, our bot has complete knowledge of every little thing that's filed a Reg D filing for a private placement of any size, and we're filtered all the way up through our criteria without, human intervention. And then we're inviting people to drop a DAC on us so we can get a detailed. But that's just one form of our sourcing. The startup runway is 1,000 and more, pre-seed companies that flow into our pipeline. That whole, then now with AI, we just don't have to spend as much time understanding whether there's a real signal here, a real
it
ready to
is
grow.
easier to settle out some of the quantitative signals, which is extremely helpful in looking at a massive deal flow. One of the things that I also wanted to focus on, though, is, in the South, where we receive as a region, even though we have 40% of the US population and 90% of the US population growth, just this last year, we only received about 10% of the venture capital. And so people here, often probably even listening to this podcast, they don't necessarily have a detailed, experienced opinion about VCs because they're not living in the heart of San Francisco or in some of the kind of blue zones of VC that are hundreds of miles away from here. VC can have a really negative reputation in the South. And I think we're all a bit colored by that. Not to say that there aren't sharp elbows everywhere, but certainly I know over the many years, you've occasionally, and I have too, gotten a reputation for a sharp elbow or two. What do you say to that? VC's tough reputations to founders who are wondering about raising venture capital because of that, just speaking for yourself. I'd love to get your thoughts.
Well, there's two tracks to that. One is the collegial sort of co-opetition with my colleagues that are venture capitalists that we can partner with, and I've partnered with most that are in the South still. But you can also compete. My first job when Wall Street made it legal for investment banks to be a part of bank holding companies again, and Morgan Guaranty changed its name to JP Morgan for the pre-Chase version. It was just they were growing a Wall Street investment bank. And I was in a training program, and that was a super sharp elbows. It was all men, of course. Maybe there was, 5% or 1% that were not men. And so it was a very caustic, insulting, one-upping, betting openly about weird, stupid stuff, and just kind of insulting each other regularly. I happen to be way better at the analysis than anybody else in the training program. And so I sort of, got enough praise to sort of say I shouldn't leave. But wow, that was my first experience. And then I went to a
That
private
sounds
equity.
rough. I mean, just
I
to
got,
comment, that sounds
well,
incredibly uncomfortable.
well, way back in 1990, where it just wasn't, a surprise to anybody at that time. The world's changed since then, favorably so. But it was also a business I didn't like much. And then private equity, I was worried that the way you win deals, it's a beauty contest. How pretty is your price that you're paying? Is the answer the entrepreneur has for who wins? And that felt like you couldn't really get any alpha out of that stuff. And it was a bunch of guys and just a bunch of, bawdy and rough and tumble behavior, just like Wall Street was. And then I met these extraordinarily amazing people that mostly had very high EQ as well as very high IQ. And I just felt at home. I felt, but then we started a venture capital firm at Council Capital. My two partners hadn't been venture capitalists. So all of a sudden I'm back in one transacting general partner. It was more stressful than expected. But what I learned from CEO council members of Council Capital, who built great companies, all of them, was how to evaluate a CEO and a leader and how to help them build a team to scale to unlimited as far as they can go. And that part, you kind of bounce around, you have strong opinions, and, you have a Master of the Universe MBA, and you can still learn a lot. if you've had a great operating experience and scaled a company that and build a great team and the company goes on beyond you. Well, that was a learned behavior. I got a lot of that at council, and I became a lot better partner with entrepreneurs. I became a lot better partner with my fellow colleagues that, we often do deals together or subsequently we've got
So
so
you're
many
telling me that
experiences.
entrepreneurs in the CEO council at council, they had the opportunity to mentor the younger version of Gary and teach
Well,
you
I
about
needed a lot of it.
leadership. I have no doubt, my friend. We all do. But
Well, the big epiphany for me was this. I was always an individual performer and I was always way out in front of my friends and colleagues. And then all of a sudden I became in a position where I needed to flip and be a good leader. Individual performer is no longer capable of to keep going. And wow, I had never had that as what was necessary. And so I got lucky that I had some really good mentors on that. And I got really good at it. And it's really been impactful on how successful I can help entrepreneurs be because I can take that style that is the one that they can handle and influence it. Sometimes, an entrepreneur is dead set and running off the rails, and you can sometimes keep 5 degrees right and stay on the rails. You got to learn.
what are some of the differences that you could call out that were important to you at this time? The difference between individual performer Gary and then Gary who learned to be leader Gary. What are a couple of threads we could, if we were watching on the wall over the years, what would we have seen evolve?
I think the evolution is a really bright line that happened and then got honed. And that is if you have a CEO that, if they've never done a financing, well, great. There's a whole lot of things you can tell them to do that are blocking and tackling of that, and you'd like them to listen. But how do you build the company, build the team, manage the team? If you're telling them how to do it instead of coaching them to do it, and you're stepping in and quote, doing their job for them and convincing them to take steps that are just your instructions to do X, then they no longer
Mm.
are CEO. You no longer see them as the leader of that company. And you should start thinking about whether you're wrong and they're a leader or whether they're the wrong person and you need a different leader. That was an interesting dichotomy for me. And it just shows up. If I've just seen it happen now enough out of 18 times, a third of them, it changed. And then how did that go? Well, I've got people that we've hired that are dear friends and the entrepreneur, replacement with the been there, done that CEO that all three of us are dear friends. That took a bit of diplomatic training that I needed to get there. But it's, one of the most valuable things I can do. So, shame on me if I didn't have a plan to make that, work.
I think one of the ways the way I hear what you're talking about is the importance of trust. And some people who work with others develop a sixth sense about when and where they can trust. They also develop a confidence in themselves that they can handle a few slings and arrows of outrageous fortune. And they may trust too much and they may be hurt, and that they can tolerate that. And I'm not saying unlimited hurt, but that bounded sense of I'll trust you this far. I'll trust you quite a bit. And by the way, I can continue to trust you more and more as you continue to prove out your own teamwork and leadership in my team. And some people don't get beyond that. They want to direct every detail. And that is a natural limiter in venture scale companies.
Well, it's a limiter in
I,
any company, really, right? If
yeah,
I'm not helping in a way that's not doing their job, if I'm doing their job, I'm damaging the company. And if I'm not coaching them in a way that they no longer need me, I'm not doing a good job of coaching because the goal is that they're a full on, done, been there, going CEO and no longer have some dependency for somebody looking over their shoulder.
so tracking Gary's arc, and, I do find you absolutely fascinating and love working with you, and you're endlessly full of enthusiasm, great information, and stunningly smart questions as we look at deals together. So I'm pursuing some of my own fun here. First era of Gary, we didn't know each other. You were a stunning individual performer. Second era of Gary, kicked off by Council Capital, mentored by a lot of great CEO Council CEOs. You become a leader of others, build trust, learn not to micromanage. One of the things that I also find so fascinating and admirable is how you've also learned how to work on a team that you're not necessarily the final word as a leader. I mean, general partner at Valor is definitely leader investment committee, but you were able to back my leadership at a very young venture firm in our first institutional fund. How did you make that transition? Who did Gary become now?
Well, I saw in you the kind of leader that you love to back as a venture capitalist. It's just that you were starting a venture capital firm. And so it was a little bit of a quandary for me. But I just, in every moment I spend, the list of things that you were very nice to say about me, my list is much longer about you. And I can say that it allowed me to do what I love without having the role in the firm that was things that I just didn't love for a ton of my time. There are things that you do great that you do as a matter of course. It's not a struggle for you, it's a passion for you. You would never see this podcast if I were the managing partner of this firm. We wouldn't have
Transparency and communication are really important to me. But, we're trying to build and, with your help, have been successful and plan to be further successful, a community of courage that can change the culture around venture capital in the South to something that everyone who has aspirations of being close to innovation, paying it forward, and seeing quality returns from their efforts can join a community of courage. And honestly, I think that does take a different move than it does in other parts of the world that are maybe more venture friendly. And your deep, real decades of experience, they're not a nice to have. They're a must have in creating that narrative that has roots. So, I mean, you're adding enormous value to that every day.
well, I just love it. The simplest way to think about venture capital is the thing that's truly rare and truly valuable is the idea whose time has come that can scale the whole market. Lots of successful companies globally. That's the true rarity. And
It is.
if you have the wrong team and don't have the right talent, you're just not going to get to take advantage of the real rare thing that you don't make up your timing. You're born when you're born. These young people today, are natively AI in everything that they do in a way that it's hard to quite imagine how far ahead of the rest of us they are. But they're the people of today building the companies that we get to back. Wow, I'm still having just the time of my life doing this.
Me too, Gary. And it's a lot of fun working together. I have to say, it gives me fond memories. We were still getting to know each other and we were working together. One of our first AI deals, I think it's been just a touch, maybe just at 5 years ago. We were talking about Alelica and debating back and forth the merits. It wasn't long after that they got one of their first offers of acquisition. And I remember how stunned, thrilled, and what a mentoring moment it was for me when I heard you say right back to the entrepreneur, well, of course, you could take this money. You could. Are you going to have another massive idea like this one to back it up with? To your point, I mean, that, of course, changed the conversation, and the founder took your coaching and advice and thought, "You know what? If I don't have another Alelica level concept stewing, maybe I should run this one out with Gary and Lisa and see what happens." So, that was fun.
Well, and right now we're all, including management, really happy that we did that and we didn't exit.
Well, they've had so many offers since then, and it's only gotten better and better, and so it's
The
really
trajectory of the company, though, now with full reimbursement, the healthcare system around the world is pretty complicated, but it's specified in guidelines. Physicians are supposed to order these tests and these fact patterns, and that is really truly hard to do. And they did it globally in medicine, and so we'll see how far they want to grow it. But
absolutely.
the first steal the company from the entrepreneur offers from the strategics, it's worth avoiding those if you've really got something.
It's one of the things that has part of the DNA at Valor now that comes from you. It is a gift of inheritance from you for
It was
sure.
painfully learned.
Your ability to set the bar because founders in the South don't necessarily, we're a lot of times told that we don't think big enough But that's not really it. I feel that the founders here are visionaries anyone and think really big. But when they get an offer that's not really big, it seems big because they're humble. And you have an incredible experience, skill, and mental perspicacity to be able to say, okay, you could take this. We're not saying never or no, but this is possible. Do you want that? And they're like, oh my God, I never even real it is possible. And
Well, there's a
that,
lot of filter on what is possible to take that way, right? We need to do
yes,
exactly what we do, same product, same prices, same sales and marketing motion with just more people and a little more capital, and we can be 20 million in a year and a half. Why in the world would you sell when you're 7.5 million? That, but sometimes the answer
it's
is, well, you should
realistic.
probably take the first offer that shows up because seed stage investing is not always rocket ship straight up and to the right. But mostly, if you've gotten lucky, you started a company and you can scale to the double digit millions, in my experience, if you get 20 million run rate, you're in the nine figure club, maybe better. And so, why wouldn't you do that? The probability of 0 to 2 is lower than 2 to 20.
It is. So I'm going to switch gears a bit and ask you a few more personal questions. Not too personal, but founders who want to get to know you and are curious about your story, I'd like them to feel a little bit more like they know the real Gary. So would you say you're a morning person or a late night person?
I'm a morning person, except for the CEOs of portfolio companies. When I'm on the board, then I'm a 24/7 person whenever they want.
Well said. What do you like to do for fun? I mean, obviously, investing is very fun, but what else?
Uh, I've become passionate about surfing and have been, combing the west coast of Costa Rica and the central coast where they've got the best surf for a home for about a year and a half, and expect that that can become a seasonal place because after the pandemic, all of a sudden we all stopped forcing entrepreneurs to pay for us to fly in airplanes to go to their board meetings in person. And so now it's possible to be effective as a VC, without having to go to every board meeting in person. And that's a blessing. Although I will say I still have a bias to want to meet in person any CEO we invest in every time before we invest, but we're both biased in favor of that.
What are some of your favorite places in the world?
Rome is a place that I love, but I wouldn't want to live there. I'd love to live in Sardinia, so it was only a 30-minute plane ride to Rome. The favorite place in the world right now happens to be the west coast of Costa Rica. It's one of the healthiest ecosystems in the world, and it's sparsely populated. And it's just like, the ideal west coast because you're a quarter mile from the beach, but you're 250 feet above sea level, and you can still hear the breaks. And you have a modern, California home, but you have 17 acres and you have no neighbors.
It sounds
Not that
amazing.
I don't like neighbors.
Would you say that you're more of a private guy or more of
Yes.
a live
Yeah,
out loud
I
guy?
can I can go, have a reading period for 2 months and not make contact with the outside world every once in a while. That's a part of my personality.
You're definitely a deep diver. I mean, one of the fun things that I don't think you'll mind me sharing is so every Monday morning we get together and William Leonard and our team runs our pipeline meeting and we go over the most rapidly moving, highest momentum deals from the last week that came in through our sourcing funnel. And Gary has essentially been marinating in Bloomberg and other sources of intel 24/7 for 3 or 4 days, and he just has the facts on stun, and it's really, really fun. And if you are an accredited investor and you would like to see this performance, by all means, let us know, and perhaps you could be a guest at one of those pipeline meetings, but it's really quite something. Sorry, Gary, I digress.
Oh,
Let
it's
me
great. No,
ask you
I
some
think you're doing something that I've always dreamed would be possible. We are taking and building our own AI infrastructure so that the ability to sort through, organize, and make quantitative conclusions in a highly accurate basis is now really presented to us by our internal software. We no longer have to compile an investment committee for and try to remember, oh, what was the ACV? How many customers did that all is served up on a platter. Now, and we've only just gotten started. So I think it's an extraordinary time, even in the VC
It
business.
really is. It really is. I absolutely love the way the data entry tedium of creating a large funnel has fallen away. and the conversation can be about momentum and where the market is moving. And of course, those are the conversations that are philosophically, intellectually, and from a returns perspective so valuable and worthwhile. It's a big part of why we got into business. So I like to wrap this up a bit in closing, letting the founders and the referral partners out there listening know what type of sectors or founders you might be looking for now. And I think maybe one way to do that, Gary, is perhaps give a moment on Valor's broader thesis, but also where some of your sweet spots and sub theses sit within it, so people know what you're really eager to see.
Well, we have been now 2 times, knock on wood, successful in legal tech. And we've had reason to learn 2 sides of legal tech and the generalist, billion-dollar raisers that one day might have, a good business. We've found moats where somebody can dominate something, and moats in the law is a gigantic profession. It's multi-trillion globally. And so we've found, ways to have a proprietary opportunity to take a market segment. No, it might not be 200 billion, but it's a couple billion of the legal industry, and put a toe in that water very successfully twice. And then sort of gravitational pull has us getting to filter a ton of things. But so that's one expertise I think we have. I would say in healthcare, my time at counsel taught me a lot about the healthcare system that I still know and understand really well. What it taught me was I only want an opportunity to invest in software that A, affects clinically the practice of medicine, and B, doesn't replace a single thing and adds competency in software that doesn't exist in healthcare. And so we've got a pretty narrow thesis on healthcare IT investments at Seed.
Absolutely. Well, thank you for your time and allowing your very private self to be a little bit more on display. A lot of people have asked, how do you and Gary work together? And the answer is, wow, shared values and very, very well. Because if you ever have the privilege of having someone who has more experience than you do in a very tough profession, and they are willing to do that, you should run down the road with that human being. And I've been really fortunate and privileged to have that here at Valor. Thanks to you, Gary Peat.
Well,
Appreciate you.
none of this would have happened without you being the leader that can build this firm well beyond even what I've been lucky to do with you. But I've still got a couple more funds left, so let's keep
Oh,
going.
the future is looking fun. And so thanks everybody for listening. If you have a deck you want to share with Gary now, let me tell you the URL. It's really easy to remember. Valor.vc/ that little ampersand mark, deck check. RAI will give you feedback in like 15 minutes, and I'll put the link in the show notes. Gary, thanks for your time.
Thank you.
The Valor Ventures podcast is for informational and entertainment purposes only and should not be relied upon as legal, business, investment, or tax advice. The views expressed are those of the individual hosts and guests and are not the views of Valor Ventures or its affiliates. Valor and its principals may hold positions in the securities of companies discussed. This podcast is not an offer to sell or a solicitation to buy any security or investment product. You should consult your own advisors before making any investment decision.